If you run your business through a company, it is vital that you understand the method that you're going to use to get funds into your personal name. You can't just withdraw money from the company's bank account and expect it just to be used personally. That is a company's profits, and you need to have a method that's going to bring them into your name. I'm going to go through the 4 key ways that you can bring funds from your company into your own name and use them personally. You do not want to get this wrong, because you could end up with a Division 7A loan that is non-complying and therefore results in unfranked dividends being deemed and declared in your own personal name and paying way too much tax because you weren't organized. So you do have multiple options when it comes to declaring income to yourself. The 4 key ways that most people would use is either wages, director's fees, dividends, or loans. So what I'll do is I'll go through each of those different options and when you would typically use them. Wages is the most common situation to be used, and it's probably the easiest to get your head around because you're going to be declaring a wage to yourself. And this wage is just like if you were earning that wage from any other company. Payroll will be processed on normally a regular basis. That could be weekly, fortnightly, monthly, where a wage will be declared to yourself. That wage will be calculated and you'll have tax withheld from that wage, you'll have super calculated on that wage, and you'll be paid the net wage into your personal bank account. These are now your funds to do whatever you want. So this wage will then be declared in your personal tax return alongside any other employment income and any other personal income you've got. From a company point of view, the wage will be a deduction to the company. So you're not going to be double taxed. If you make 150 grand profit in the company and you pay a $100,000 wage to yourself, you're going to end up with $100,000 of income in your personal return and $50,000 of income in the company tax return. So this strategy is typically used when people want to pay themselves a regular amount, especially if they're working full-time within this business and they're not receiving any other source of income. They're obviously going to want income to live off personally, so they normally declare a wage to themselves. This is the exact thing that I do within my business, is I pay myself a regular wage each week that then gets taxed in my personal name and allows me to get funds out of my company into my personal bank account that I can then spend personally. The second option is director's fees. Now these are very similar to a wage, and that is because they still have to be processed through payroll, they still have tax withheld on them, and they still need to have super paid on top of them. So you can't just declare a director's fees and avoid your super obligations or tax withholding obligations. Director's fees are therefore typically only used these days maybe to pay an ad hoc payment, so maybe you're paying something maybe once a quarter or once a year and you just pay an amount, or maybe it's an extra amount, or they typically will be used for non-working directors. So if you're not working within the business but you're still a director, you may receive a director's fee. Maybe you sit on a board, for instance, and you receive a director's fee maybe once a year or once a quarter. Again, it still gets processed through payroll, so therefore it's still a deduction to the company, and it is still income in your personal name, no different as a wage. Now, before I talk about dividends and loans, I'd love for you to join my email newsletter, because I drop tax tips every single week along with other personal finance and business related tips. It's very easy to join. It's free. The link is in the description to this video. Now let's move on to dividends. So the director of a company may also be the shareholder, or they may have an entity that they control that is the shareholder, and therefore another option to get profits out of the company and into a personal name is via dividends. A dividend is a payment from a company to its shareholders out of its profits that then brings money into the shareholders' names. So you might have shares that are owned by one person, we'll call them John Smith, and they are the director of John Smith Proprietary Limited. So John Smith Proprietary Limited might have made $100,000 in year one, and during that second year, they may want to declare a dividend. So they declare a dividend to their shareholder, John Smith, and they might declare a $20,000 dividend. So that $20,000 can now be paid from the company to John Smith as an individual. So that is now going to be income in John Smith's name. Now, that dividend could be franked or unfranked. So if it is franked, it involves a tax credit for the tax that the company has already paid on that income. Now, this will depend on what the tax rate is and what percentage is franked, because you could have a partially franked dividend. So you can work it out. There's lots of calculators. Here's an example of one. So if we have a $1,000 dividend, we will have a franking credit of $333.33. So in John Smith's name, we're going to have taxable income of $1,333.33, and we're going to pay tax at our marginal tax rate. So let's assume the marginal tax rate is 34.5 cents. So the tax on that $1,333 would have been $460. Now, because there is already that franking credit of the $333.33, the extra tax in essence is going to be $126.67. So you are going to eventually pay tax at your personal marginal tax rate if you receive a dividend, But the advantage is if the company's already paid tax, it can include that as a franked dividend and therefore include those franking credits to reduce the amount of personal tax paid. Now, if your marginal tax rate is lower than what the company has already paid, so the 25% for a small business company, then you actually could receive a refund. So if you've got no other income and you receive a small dividend from your company, then you actually could receive all the tax back. Now, one thing to remember with dividends is they need to be paid out proportional to the shareholding. Now, this can be slightly different if you've got multiple classes of shares. But if you've got 100 ordinary shares and you own 50 of them, and maybe your wife owns 50, then any dividends will be split 50-50 because that is how the shareholding is done. So dividends can be paid on a regular basis or an irregular basis. They might be calculated based on profits or some other kind of formula, or just be a completely made up amount. There is no set rules on this. For instance, within my business, I pay a quarterly dividend to my shareholders, which is me, and that is based on the profits that I've done in the prior quarter. Now, the last option is loans. And the reason why it's a loan and not just a withdrawal like as a sole trader is because the money isn't yours. We talked about at the top of this video, if the company has money in its bank account, that is the company's money. So if you use that personally, whether you go buy something directly through the company account that is a personal expense, or you send that money over to your personal account, you're now creating a loan. You now owe the company money. And this is a tricky option because it is more complex than any of the others. Because if you have a loan, it needs to be repaid by a certain date. If that doesn't happen, you now have what they call a Division 7A loan. Now, this is a loan that needs a written agreement with terms on how it's going to be repaid, what the interest rates are, which are typically the ATO benchmark interest rate. And we also need a term. So if it is an unsecured loan, it has a maximum term of 7 years. You then need to make sure the repayments are met on this, or you will become non-complying and you could end up with a deemed dividend. So this is a dividend that will be declared in your own name, that will be completely unfranked, and you really don't want that to happen. The Division 7A loan also needs to have interest, as I mentioned, and this goes off the ATO benchmark interest rate. So you can see here that the current rate is 8.27%. So it is quite high. So if you're going to go down the path of loaning money to yourself, you really need to have an understanding of what it's actually going to cost you, not only in the interest rate, but any compliance costs. You might have additional accounting fees, like I said, legal fees to get this document drawn up. Loans are typically a last resort or used in really particular situations. It's going to be something you're likely going to seek legal advice in and potentially tax advice as well. Now, if you're wanting to grow your business, but you're really struggling with it, this upcoming video I've got, I talk about all the main reasons why a small business struggles to grow and some of the key solutions that you can put in place to make sure your business actually grows. I look forward to seeing you over there.